Hello, and welcome to another episode of ETF 360. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and today I'm pleased to be joined by Joe Becker, Director of Product Management at Innovator ETFs. Innovator, of course, has been a pioneer in the defined outcome ETF space, and he joins us now to discuss one of their newest product launches this year. Joe, thanks so much for joining us today.
Thank you for having me. Good to be here.
Yeah. So first off, I want to talk about the broader derivatives business. Derivatives-based income ETFs have really seen monster interest, monster inflows over the last 5 years, and they're continuing to gather steam in 2025. And almost all of those assets, by the way, are held in covered call ETFs. Can you explain the basic mechanism there?
Yes, you're right. There has been massive demand of late. The first derivative income ETF was launched in 2007, so a long time ago. And as recently as 2020, there was only about $2 billion in the whole space. But as of today, we're sitting at $110 billion. So a lot of growth just in the last 5 years. And as you said, a lot of that, 95% of that is in ETFs that are doing covered call strategies, right? They are holding equities in some form, and then they're simply selling calls against those equities to generate income. And that's the basic idea. And you can see investors like that idea, an alternative source of income from traditional bonds or other traditional sources, a great way to get monthly reliable income.
Yeah, absolutely. Very, very popular. So why are covered call ETFs, in your mind, perhaps not the most efficient strategy for navigating today's turbulent markets?
Yeah, I don't know if I would use the word like insufficient. Maybe a challenge that covered call ETFs face is that they hold equities and then they're selling this call, and there's a sense in which these two things are kind of opposed to one another. When you sell a call, it limits the upside potential of your underlying equities. Or if we put it another way, when the market climbs, that depletes the value, that turns your call into a losing position. And so it does generate monthly income, and that is great, and investors love it. But we thought, could we do something that could generate income and maybe benefit from the market climbing?
Right. There's always that capped upside issue there with covered calls. So let's talk about your fund, the Innovator Equity Premium Income Daily Put Right ETF, ticker SPUT. This fund actually focuses on options overlays using puts, not calls. Tell us about that. How does this address the solution of some of that maybe lackluster performance from some of these covered call funds?
Again, when we came into this segment of the market, we wanted to enter the space. There's great demand for it, but we wanted to differentiate. And SPUT, as we think about how it works, covered calls are a great place to start. SPUT is holding equities and it's selling options for income, just like covered calls. As you said, the difference is that instead of selling calls, SPUT is selling puts, and it's selling puts every day, a one-day put every day. And so what does that mean? How is that different? What are the implications of selling a put instead of selling a call? One of the biggest differentiators, one of the most important features, is that puts actually generate more premium than calls do. If you take a call and a put that have the same characteristics, that put will almost always have a higher price. And as option sellers for income, we like higher prices. And so that's one reason we like selling puts instead of calls. The other reason is that put, it doesn't stand in the way of your equities. The market can climb without being capped. The market can climb without that put losing its value or turning into a losing position. And so this was the goal, really, to create meaningful income with capital appreciation potential.
Got it. It's interesting. When you think about most put writing strategies out there, they often tend to just hold treasury bills or cash, but no equities. So, you mentioned equities. How does SPUT differ there?
Right. SPUT has a 50% allocation to equities. It's large cap S&P 500 equities. And so in addition to holding that position and getting the benefit of the potential for capital appreciation, we're then selling puts to generate that monthly income, selling puts every day. Again, enjoying some what is usually higher premium than what you would get from comparable call options. So as we put it all together, you're thinking about the equity exposure, the income. These combine to also create a strategy that is low volatility. We expect that the yield on this to be between 6 and 8%. We actually just made a distribution that came in at 9% because April was so volatile, right? And we collected so much premium. But we anticipate the yield to be between 6 and 8%. And over the long term, we expect the strategy to exhibit about half the volatility of the S&P 500.
All right, perfect. There you have it. That does it for ETF 360. My thanks again to Joe Becker for joining us, and thank you all for tuning in. We'll see you next time right here on ETF 360.
Thank you.